Good morning, everybody. So, yesterday, for the first time this entire year, I sent out to my MMT+Trader subscribers and people on the list our first short hedge position on the stock market. I have turned defensive on the market, and the reason for this is now it is pretty obvious we are seeing a slowdown in government spending. Those fiscal flows that I talk about all the time and that I focus on, and which have been really the driving force under the stock market and also keeping the economy out of a recession, those fiscal flows are slowing down. Doesn't mean they're contracting. They're just slow. They're just growing at a much slower rate. Now, I've used the analogy in the past of a swimming pool filling up the pool with water. There's a hose with the water flowing up out. That would be the government spending, and there are always leakages in that pool. Okay, savings is a leakage, imports are a leakage, taxes are a leakage, etc. As long as that water is flowing faster than the leaks, the pool fills up. However, if the flow of water slows down, the pool might be filling up, but more slowly. That's the situation we have right now. So we're seeing a pullback in the stock market, and I have recommended some short positions now. All of this can go away if the Fed raises rates next week. And I know maybe to some of you that sounds, counterintuitive. How can it be? How can it go away if the Fed raises rates? Won't it make it worse? But I've been all through that. A rate hike is the same thing as a helicopter drop. It requires the Fed to give money to people. Okay? Or it could also go away if we have an acceleration in bank lending. We saw some early evidence, or I saw some evidence of that last week in bank loan data, up 54 billion in 1 week. That was the biggest increase in 4 years. But 1 week doesn't necessarily make a trend. I have to see what this week looks like, and I won't get that number until later today. So right now, the stock market looks like we are in a correction mode, okay? In addition, if spending is indeed slowing down, which it is, that is not good for gold. It is not good for foreign currencies. It is not good for commodities, including oil. It is good for the U.S. dollar. Less U.S. dollar flow from the federal government of the United States equates to support for the dollar in foreign exchange markets. Anyway, I just wanted to put this out there quick. All of you who are on the MMT+Trader list, you know about this. You know about my recommendations. If you are not on that list, if you want a 30-day free trial of MMT+Trader, then go to my website, www.pitbulleconomics.com, and click on the tab that says products. I will be writing about this extensively in the new report over the weekend, along with other recommendations. So you will be updated about my thoughts on this and what is going on. And I'll have all the new data, including this week's data for bank lending. I mean, if we see another upsurge in loan creation, that could mitigate this whole thing. But I'll keep you informed. Anyway, that's it for now. See you later. Bye-bye.